Few days ago, the big news was that the US debt government downgraded again, this time by another credit rating agency known as a Fitch from AAA to AA rating. So how this affects you as a stock and real estate investor? Let's find out more in this video.
Buongiorno!
So first, a bit of a background. The US government debt, also known as US Treasury, they are rated by three main rating agencies. The biggest rating agency is known as a Standard & Poor's or S&P. The second biggest rating agency is Moody's, and the smallest rating agency is Fitch. So what they're doing? They rate bonds of governments and corporations from AAA rating to AA to single A or to BBB. Basically, they rate how safe the bonds are. Now, historically, the US government debt and the US Treasury have a AAA rating. What happened back in 2011 was that the market was short because for the first time, S&P downgraded the US debt from a AAA to a AA, and it remained AA plus since then. Okay, but what happened like a few days ago? Fitch decided to join S&P and say, okay, we also think that the US government debt should be AA plus. So they announced that they are going to do a downgrade, and that's what's causing all the panic. So now often I get asked this question, Emanuele, are you concerned about the US government debt is downgraded? You know, one of the reasons why it's downgraded is because Fitch said that the country is just getting too much debt. And now the US debt to GDP ratio is going to reach 118% in 2025. So am I concerned about this ballooning government debt in USA? My answer honestly is not at all. I've got zero fear and concern. The first reason is that, understand, I don't invest in US government debt. I invest in US stocks. Now, when you buy a US stocks, you are buying shares of a business. So I'm a part, for example, owner of Amazon, I'm a part owner of Meta, I'm a part owner of Microsoft, and this company I choose have solid balance sheets. They are strong company with a little debt themselves. So theoretically, even if the US government got into trouble and they couldn't pay their debt, for example, which will never happen, by the way, I think. But even if, I don't care. Why? Because I don't own US government debt. I'm owning great companies, so the important thing is that the individual company that you invest, like for example Microsoft or Amazon or Meta or Adobe, as long as this company don't have high debt, the company themselves have low debt and a lot of cash, who the hell care? The same thing is for buildings. As long as they have strong financials, is the same concept. So the only indirect repercussion is that if, for whatever reason, the US default on its debt, which again I think is impossible, but let's say one day they do, what's the repercussion? The repercussion is that the interest rates will go sky high, skyrocket. Because if people feel that the US debt is risky to hold, they will demand a higher interest rate to hold them, and to all that debt, and that could cause interest rate to spike so high and could cost companies a lot in order to borrow money. Same concept for the building that they don't have strong financials and they need to borrow money. This could be a big problem. That's why you always gotta invest in building or buy building with strong financial and ask your broker to do diligence on that. So having this concept is going to be more difficult for companies and building to borrow money. As a stockholder, this concern you? Of course, if you invest in companies that require a lot of debt or buildings that have a lot of debt in financing, then you're screwed, right? But again, if you invest in building or company that have solid balance sheet, got a very little debt, then you don't care. Number two, I've also shared before that if you look at the total government debt, you got to understand that 22% of the federal government debt is held by local governments. So in other words, it's like left pocket, right pocket. So who does the federal government owe you money to? The local governments, right? And 52% of the rest of the government debt are held by domestic holder. In other words, American themselves, like us. And 40% of that 52% is the Federal Reserve. Okay, so again, left pocket paying the right pocket. So in general, 74% of all government debt is held by Americans. Now, yes, the US government debt has been rising and rising and rising over the years, but is really too high? Well, you have to do this comparison. Compare the debt to the GDP ratio, because this tells you that they've got so much debt. But what's the GDP? The GDP is the income of the country to pay back the debt. What's the figure you're looking at? If you take a look at the US debt to GDP ratio, it is currently around 116%. Again, Fitch is saying that it's going to be 118%. Now, is that very high? Well, it's all relative. Take a look at Japan. Now, Japan's stock market has been doing really well recently, right? Japan debt GDP ratio is 239%. It's a lot higher than US debt. Singapore, the same. GDP ratio 165% is a lot higher than US. I mean, of course, Singapore is a bit of an outlier because Singapore has got a lot of assets, so they can really easily pay back the debt. So it's a net creditor nation, by the way. So in a summary, am I worried about the US government debt losing its reputation as a safe haven, risk-free asset, real estate stocks, and whatever? Not at all. To me, it's the safest asset you can ever buy. Although the yields to me are very low, so I don't bother buy them. I'm talking about the treasury bonds. So does this mean that the downgrade of the US debt has no impact on the stock market, no impact on the bond market, no impact on real estate? No, there is an impact. But the impact is a short-term impact, and it's purely psychological, purely emotional, which is something that you can take advantage of as a rational investor. So let's take a look at the last time that this happened. This was back on the 5th of August 2011. Now, that was the first time the S&P downgraded the US debt from AAA to AA+. Now, when it first happened, it came as a shock to people because it would never happen before. So people never thought that the US could lose the AAA rating status. So because of that shock, the stock market went down, and real estate as well. How much did it go down? It actually went down about 10.5% as a result of this downgrade. Now, again, was this logical? No, it was purely emotional because nothing changed. The US debt was just as safe. People were still buying it. In fact, there is a joke. This is really a big joke. The joke was that after the downgrade, what happened to US Treasury yields? US Treasury yields collapse. Now, what does that mean? When Treasury yield collapse, that means the Treasury bond prices go up because bond prices move the inverse of yield, right? So why did the bond price go up? Because people were buying bonds. So that's the irony. When S&P said that the debt is less safe, more people bought the debt, more people bought bonds. And by buying more bonds, the bond price went up and the yield went down. So that goes to show you how freaking illogical the market is. It's like something is worth less, so let's buy more of it, okay? I mean, it's crazy. Okay, now at the time the stock market went down by 10.5%, and like I said, it was a purely emotional sell-off, and real estate as well. That was a gift, right? So whenever the market gives you this gift of buying stock or real estate at discount, you gotta grab it. And 6 months later, boom. In fact, the market was up 31% and real estate as well, 6 months later. So now that it's up in a second time in 2023 and the market is now saying, hey, I've seen that movie before, okay? So people are asking this time, could the market also collapse another 10% because of this downgrade? Now, everything is possible, but I don't think so. Why? Because again, the market is not stupid. The market saw this movie before, and this is nothing new. It's no longer a shock to them. They remember that the market last time it happened was a short-term drop and went up again. So market understood this and will not make the same mistake. The other interesting thing is that when Fitch downgraded the debt, yes, the stock market dropped the last 2 days. But if you ask me, is not a downgrade that caused the drop in stocks? No. The market was due for a pullback anyway because of seasonality. August and September tend to be seasonally bearish. And given the fact that the market went up so much in the last 10 months, I mean, it's obvious that it has to come down. Nothing goes up in a straight line. Neither stock, neither real estate, neither crypto, nothing. And you know, market makers have been itching for an excuse to push prices down to shake out the weak holders. So when they got this downgrade news, it was a great excuse for them to push the market down. So remember that the market is totally manipulated in the short term. It's totally manipulated, all right? Whether it goes up or down, it's manipulated. There's nothing you can do. They just need to find a reason or a news to justify the manipulation. That's why when you read the news, you're already too late. Buy the rumor, sell the news, guys. I always told you. But what was interesting this time, remember in 2011, when the debt was downgraded, the treasury yields went down, right? But this time the treasury yield went up. It's like the opposite. How come? So why this treasury used to go up now? Remember, when treasury yield used to go up is because treasury bond price go down. is the opposite. Right, let me write it down. When the bond prices go down, you can take a look at the bond prices by looking at the ETF. You can look at the TLT ETF that tracks down the 10 and 20 years treasury bond. The TLT price collapses and the yield went up. What's any relationship? It is because of the downgrade causes people now to sell bonds and causing bonds to go down, and then they used to go up. I don't think so. I don't think that's a reason, because remember that back in 2011, the downgrade did not cause a sell-off in bonds. It caused the buying of bonds. So in this sell-off, the bond market and the rise in yield is caused by something else. The first reason why treasury bonds prices are falling and treasury yields are rising is because of the stronger than expected economy data GDP. Economy is great in America lately. Q2 was better than expected. It was strong employment data, very strong earning, especially from cyclical company like construction company like Caterpillar, which this is really good for real estate. It means they are building buildings, you know. So ADP just announced about 2 days ago that private payrolls gained the most since July. Employment rose 296,000 in April, topping all estimates. So the job growth is extremely strong. At the same time, for example, Caterpillar, which is very important for real estate, reported their sales surged double digit, and there is a construction boom. So there is a rose market ahead for real estate. So why is it when the economy is very strong, bond prices fall and yields rise? This is economics 101, guys. Remember that when investors see a growing economy, they tend to sell bonds and use that money to buy back stocks. So by doing that, selling bonds, less demand for bonds, bonds prices fall, yields rise. That's the first reason. Now, is that a good thing? It's a good thing, right? Strong economy, bonds prices go down, yields goes up. Second reason why bonds prices are falling is because there is a big supply of bonds recently by the US Treasury. So, the US Treasury has recently been selling more bonds than usual in order to fund a bigger government deficit. So, by selling more bonds, what happens? Supply increases, bond prices fall, yield rise. So it's a combination of strong economy and more treasury sales that are causing treasury yields to rise. So you can see the impact on the treasury yields, very, very high. So having a very high treasury yields is good or bad? Well, like everything else, there is good and bad. So what's the bad thing? The bad thing is that when treasury goes up, mortgage rates goes up, which means now it's more difficult for people to buy houses. So this could reduce the demand for housing in US, and this could lead to a collapse of housing prices. But then you could also argue that there is no supply in housing because there is a limited amount of supply, and housing and people who have houses are not selling because they bought them a much lower mortgage rate, and that's why home prices are still going up despite the treasury yields going up and mortgage rates going up. And by the way, many people are deciding to renting instead of selling it at this moment. Okay, the second bad thing that could come out of this is that now remember, what happened the last time treasury yields went up so much? We had a lot of bank failure. Remember, Silicon Valley Bank collapsed, Signature Bank collapsed, because many of these regional banks, they hold treasury, so they hold all of this treasury as an asset. So when the treasury price collapse, when they fall, the bank asset go down, and if it goes down too much, then the bank could become insolvent and it could lead to a more bank failure, unfortunately. They could be liquidated. So could that happen? Is that possible? It is possible that this could happen. So this is something bad that could come out of it. Another concern would be, of course, as treasury yields rise, that means that the cost of borrowing goes up. So again, as I said before, for companies that require a lot of debt, in order to make their business, it will be more difficult for them to borrow money and more expensive. Same for buildings that they have a lot of debt. They could become insolvent. So they have now to pay high interest rate on their debt, and that could cause company and buildings that are very high leverage also to collapse. So that's actually a bad thing. Now, what's the good thing? The good thing is that a higher 10-year treasury yield is an indicator of a stronger economy, and that's why people are selling off bonds and going to equities because of a strong economy. It is also good because it is the beginning of the inverted yield curve. Now, remember that for many months, a lot of bears have been saying that the yield curve is inverted because of it's a bad thing. Right now, what does the U-curve inversion mean? It means that the yield or the interest rate on short-term debt, like the 3 months debt, is higher than the yield on long-term debt, for example, the 10 or 20 years. So right now the treasury yield curve is inverted. Inverted curve, people say, is a bad thing that could lead to a recession. So what's happening now is that the short yield, which is the 3-month yield, is affected by the Fed funds rate and the Federal Reserve. Now the Fed is now saying that they are not going to raise much anymore, the interest rates. So people believe that the Fed gonna hold on and even cut in a while, which I believe it's real. So in another word, the short end of the curve should be more or less fixed for now. So to uninvert the yield curve, what has to happen? That's right. The long-term bond, which is the 10 years, and the 30 years yield has to go up. So if this goes up, the yield curve will then uninvert and then have got a normal yield curve, which is healthy for the economy. Bottom line, how does this affect us as an investor of real estate or stock? How can we use this knowledge to make better investment decisions? So let's first turn into the stock market. Now, always remember, I keep saying this in every video, no one can predict the short-term direction, no one can predict the stock market decision, but because anything can happen and there are just too many moving parts, that's why nobody can predict it. All we got to do is easy and simple, is to invest in high quality companies, high quality building, and look at probabilities. So if, for example, you look at the S&P 500, I've already said many times that August and September are seasonally bearish, and early part of October tend to be seasonally weak. And especially after a strong run-up in the last few months, we need to expect a pullback or maybe a small correction, which is healthy for the stock market to shake out weekends older before the market surges again and can take on other people and finish strong by the year end. So again, the downgrade by Fitch, I think, was a good excuse for market makers to push the prices down. But I believe that this is just a short-term price manipulation like every time. So all we have to do is just take advantage of this manipulation, buy more stock, buy more real estate, and take advantage of it. Thank you guys. Io Emanuele Fiorazzera. I can't wait to see you in the next video.